the new Fed chair just walked in the door with one job: not grow the economy, not protect jobs, kill inflation. And as of right now, traders on CME FedWatch are putting a 60% chance on a rate hike before December. If you're holding JEPI, if those monthly checks are covering your power bill, your groceries, maybe part of what you owe on the house, I get why this week felt uncomfortable. That's a real feeling. And it makes sense. Because for 20 years, the story has been the same. Rates go up, dividend income gets hurt. That's just how it works. Except here's the problem with that story. It's not actually true for JEPI. And the data going back to the last time the Fed did exactly this, raised rates 7 times in 1 year, tells a completely different story than what you're probably reading right now. I want to show you that data. Because once you see how JEPI actually makes its money, the rate hike headline stops being the threat. It might actually be the tailwind. So let's talk about what's happening in the market right now, because none of this is hypothetical. April's inflation number came in at 8%. That's the hottest reading in nearly 3 years. Oil prices are elevated. Gas prices are elevated. The Middle East conflict is keeping energy costs high, and nobody knows when that changes. And the wholesale price index, PPI, just printed at 6% year over year. That's the fastest pace since 2022. The bond market didn't wait for the Fed to react. The 30-year Treasury yield hit 19% this week. Last time it was that high was July 2007. The 10-year jumped to 69%. And the 2-year yield crossed above the federal funds rate, which, historically, tends to be a signal that the Fed is behind the curve. Kevin Warsh got sworn in as Fed chair on Friday. He's been an inflation hawk his entire career. He wrote about it, he talked about it, and now he's running the institution. Markets are pricing in 0 cuts for the rest of the year and a meaningful probability of an actual hike. So yeah, I understand the nerves. You've been collecting that monthly JEPI check, maybe $300, maybe $700, maybe more depending on how much you have in it. And now every headline is telling you rates are going up, and you should be worried. The instinct is to do something. To sell. To protect. But here's what I want you to hold on to before we go any further. JEPI is not ad intent. It's not Coca-Cola. It doesn't work the way a traditional dividend stock works. And when you understand how it actually generates income, this whole conversation flips. Most of the videos out there make the same mistake. They see dividend ETF, and they apply the standard rising rate playbook, yields become less competitive, valuations compress, investors rotate out. That logic is completely valid for a utility stock, or REIT. But JEPI's income doesn't come from dividends. Not primarily. JEPI runs what's called a covered call strategy. The fund holds roughly 100 defensive stocks, things like healthcare companies, consumer staples, industrials, solid, boring businesses. But the income you receive every month, most of that comes from selling call options on the S&P 500. Every single month, JPP sells those options and collects the premium. That premium gets paid out to you. Here's why this matters so much right now. Option premiums are not set by interest rates. They're set by volatility. Specifically, by how much fear is priced into the market at any given moment. The VIX is the number that measures that fear. Right now, it's sitting around 24. It's been above 22 since March. It's spiked above 30 multiple times this year. Think back to 2023 and 2024. Markets were calm. The VIX was hanging around 15, and during that stretch, JPI's monthly distributions were modest, sometimes 33 cents a share, sometimes 38 cents, because when the market is quiet, options are cheap. Low fear, low premium, lower check for you. Now look at what happens when fear spikes. In 2025, JEPI's monthly distributions swung between 33 cents and 54 cents per share. That's a 66% range in a single year. The fund didn't change. The strategy didn't change. What changed was volatility. When the VIX rose, options got more expensive, JEPI collected more premium, and your monthly check got bigger. The trailing 12-month distribution as of right now is $4.76 per share and 8.4% yield. Analysts who specifically track covered call strategies have been pretty direct about this. 2026's volatility environment is close to ideal for premium generation, not despite the fear in the market. Because of it. I want to be direct about how I think about this because I think it's the most important reframe in this entire video. JEPI is not a promise. It's a machine. And this particular machine runs on volatility. When the market is nervous, when inflation is uncertain, when the Fed is unpredictable, when oil prices are spiking, that machine runs harder. The same anxiety that's making bond investors sell is the same fuel that's making JEPI's monthly check larger. That's not spin. That's literally how the math works. Now let me show you that this isn't just a theory, because we've actually lived through this. In 2022, the Fed raised interest rates 7 times. That's the most aggressive tightening cycle since Paul Volcker in the early 1980s. The S&P 500 dropped 1% for the year. Bonds, which are supposed to be the safe part of the portfolio, fell hard. The classic 60-40 portfolio lost double digits. It was a brutal year for almost every traditional investment strategy. JEP fell 5%. And while it was falling only 5%, it was paying monthly distributions the entire time. Because VIX was elevated all year. Because fear was elevated all year. Because every call option JEPI sold was generating richer premium than it would have in a call market. Rate hikes didn't hurt JEPI in 2022. They created the volatility that made JEPI's income engine run better. So sit with this question for a second. If JEPI held up that well during the last rate hike cycle, down 5%, while the S&P lost 18%, and if the conditions setting up right now look a lot like that same environment, why is the dominant narrative treating this like it's bad news for JEPI investors? Alright, I've made the case for why rate hikes aren't the threat most people think they are for JEPI. But I'm not going to sit here and tell you this fund is perfect. That's not useful to you. There is a real risk. It's just not the one that's all over the headlines right now. Here's how the covered call structure actually creates a ceiling on JEPI's performance. Every month, the fund sells call options, and in doing so, it essentially agrees if the S&P 500 rallies hard past a certain level, we don't fully participate. We collect the premium. We give up some of the upside. That's the deal. Most of the time, in uncertain or volatile markets, the trade-off works in your favor. You take the income, the market grinds sideways or down, and you come out ahead on a total return basis compared to just holding the index. But in a straight-up bull market, the kind where the S&P runs 25 or 30% in a year, JEPI gets left behind. The upside gets called away. The income keeps coming, but the NAV doesn't keep up with the index. Look at 2023. The S&P returned over 26%. JEPI returned about 8%. Look at 2024. S&P up 25%. JEP up 6%. If you were a growth investor watching those numbers, you were frustrated. If you were retired and spending those monthly distributions to pay bills, you probably didn't lose sleep over it. Those are two completely different ways of experiencing the same fund. So the honest question isn't, is a rate hike bad for JEPI? The honest question is, what kind of market do you think we're walking into? If the next 18 months look like inflation hanging around, a hawkish Fed chair trying to prove himself, oil prices staying elevated because of geopolitical uncertainty, and a market that chops around without a clear direction, JEPI is exactly where you want to be. That's its best environment. If you genuinely believe the S&P is about to launch into a clean 30% bull run in a world with 4.69% treasury yields, 3 8% inflation, and a new Fed chair with a mandate to tighten, then yes, JEPP will underperform. But I'd want to understand what's driving that belief, because the setup for that scenario doesn't feel obvious to me right now. There's one more thing I want to address, and it almost never gets talked about in JEPI videos. Tax treatment. JEPI's distributions are mostly ordinary income, not qualified dividends. That's a meaningful distinction for anyone in a higher tax bracket. If you're in the 22% federal bracket, you're 8. 4% yield becomes roughly 6. 5% after federal tax in a taxable brokerage account. If you're in the 32% bracket, and a lot of people watching this with $500 to $1 million saved or somewhere in that range, you're looking at closer to 5. 7% after tax. That's still competitive. A 10-year treasury at 4. 69% is technically risk-free, but it's also ordinary income taxed the same way. So the spread between JEPI and bonds doesn't collapse as much as it might look on paper. But the 4% headline number is not what most of you are actually keeping. This genuinely frustrates me about how JEPI gets covered. Everyone leads with the headline yield because it's the big number. But a yield you don't get to keep isn't really a yield, it's an illusion. The number that matters is what clears into your account after the IRS. And for high-income investors, the cleanest solution is simple. Hold JEPI inside a traditional IRA or a Roth. Then 8. 4% is 8. 4%. No asterisk. No tax drag. No unpleasant surprise in April. Let me make this concrete because I think the math is more useful than the theory. Say you're 57. You got $400 in JEPI sitting in a rollover IRA at today's 8. 4% yield, that's throwing off about $33,600 a year. Call it $800 a month landing in your account. Now the rate hike news hits. Markets get choppy. VIX moves from 20 up to 28. Here's what actually happens to that $800. When volatility is elevated in that 24 to 28 VIX range, JEPI's option premiums expand. The fund collects more income from each contract it sells. Historically, that kind of elevated VIX environment pushes JEPI's annualized yield toward 9 to 10% on current NAV, which means that same $400 position starts generating somewhere between $300 and $300 a month. The rate hike, the thing that's supposed to hurt you, is actually increasing your monthly income. And while that's happening, your JEPI position is moving at roughly 65 cents for every dollar the S&P moves. Beta of about 0. Beta 65. So if the broader market sells off 10% on rate hike fears, your JEPI position is likely down somewhere around 6 to 7%. Real money, yes. But you're absorbing about 35% less pain than someone holding straight index funds, and you're getting a bigger check at the same time. So here's what I keep coming back to. If higher volatility means higher income, and we've just established that it does mechanically through the options premium, and if rate hikes are the primary driver of higher volatility right now, what does that actually mean for the conventional wisdom that says sell your income ETFs when rates go up? Because that advice might be right for a lot of things. It's not right for this. Okay, let me give you my actual take. Not the balance, cover every angle answer. The one I'd give a friend who called me this week asking whether to sell their JEPP position. I wouldn't sell it. And here's why. JEPI doesn't need anyone to defend it right now. The 2022 data does that on its own. Fed raised rates 7 times. S&P fell 18%. Bonds collapsed, and JEPI dropped 3. 5% while paying monthly income the entire year. If you're looking for proof that this structure was built for exactly this kind of environment, that's it. You don't need a theory. You have a live test. That said, there are 2 things I'd actually pay attention to right now, and neither of them is the rate hike. The first is NAV drift. This is something a lot of JEPI holders don't fully account for going in. Because the covered call structure caps JEPI's upside in bull markets, the fund doesn't recover NAV as quickly during rallies. Over time, if you're reinvesting distributions, this matters less. But if you're spending those monthly checks, which is why most of you bought this in the first place, you need to understand that your $400 position is not designed to become $600. It's designed to generate consistent cash flow. That's not a flaw. That's literally what you're paying for. The 5-year total return, including dividends, is 43%, which works out to about 6% annually. That's a real functional number. Just don't mistake it for a growth vehicle. The second is tax location. I mentioned it earlier, and I'll say it one more time because I think it's the single most actionable thing a lot of JEPI holders can do. If you're in a 32% bracket and you've got a significant JEPI position in a taxable brokerage account, you're leaving real money on the table. On a $400 position, the difference between taxable and IR treatment is somewhere between $50 and $80 a year. Every year, that's a conversation worth having with your advisor or your accountant before the end of the year. Now, the bigger point. Kevin Warsh walking in the door, inflation at 3%, 8%, the 30-year Treasury at 5%, 19%, the VIX sitting at 24%. This is not a normal environment. And the instinct for a lot of investors is to treat abnormal as dangerous and go defensive. But here's what I think is actually happening. For JEPI specifically, this environment isn't an exception. It's the use case. The fund was designed for exactly this: uncertain markets, elevated volatility, investors who need income and can't afford to absorb the full swing of the S&P. That description fits a lot of people in their late 50s and 60s right now. And this market is delivering the conditions that make the strategy work best. The fear in the market right now is real. I'm not dismissing it. But fear in options markets has a price. And JEPI is collecting that price from you every single month in the form of your distribution check. Here's the way I actually frame this for myself. There are two kinds of investors in a rate hike cycle. The first kind is watching a number. They're refreshing their brokerage account every morning, looking at their total balance, calculating what their portfolio is worth on any given Tuesday. Every red day feels like a loss. Every headline about rate hikes feels personal. The second kind is watching a flow. They care about one number. Does the check still come on the 5th of the month? Is it still $2,800? Is it 3-0 now because volatility went up? They treat the portfolio balance the way most people treat the value of their house. It fluctuates, and that's fine because they're not selling it. They're living in it. JEPI was built for the second kind of investor. If your monthly distributions are funding actual expenses, if that income is part of how your retirement actually works, then a temporary dip in and a V during a rate hike cycle is not a crisis. It's just noise. The check is the signal. I do want to name one real risk before we wrap up, because I think it deserves more honesty than it usually gets. The scenario where JEPI genuinely gets hurt isn't a rate hike. It's a sustained, severe bear market. Think something that runs 18 months, with the S&P down 30% or more. In that environment, JEPI's equity sleeve loses value too. It loses less than the index. That 35% beta buffer is real, but it still loses. And when NAV drops significantly, the dollar amount of your monthly check shrinks even if the percentage yield stays the same. Here's the math. If JEPI's NAV fell from $57 to $42, that's roughly a 26% drop. Your $400 position is now worth $296. And even at a 9% yield on that reduced NAV, you're collecting about $200 a month instead of $800. That's a real reduction. So don't let anyone tell you JEPI is immune to a bad market. It isn't. It's just better positioned than most alternatives for the specific environment we happen to be in right now. Let me leave you with one framework before we close out, because I think it's more useful than any specific opinion about JEPI. I call it the signal versus noise filter. And it applies to basically every financial headline you'll read this year. When you see Fed rate hike coming, that's a real event. But the question isn't, is this event happening? It's how does this event actually affect the specific thing I own and why I own it? Rate hike bad for dividends, that's the noise. It's a generic rule of thumb that applies to some things and not others. Rate hikes increase volatility. Volatility increases option premiums. Option premiums are what JEP pays you. That's the signal. That's the mechanism. That's what actually matters. JEPI, yield too high to be sustainable, noise. That's a number without context. JEPI's yield is a function of volatility. In calm markets, it runs 7 to 8%. In volatile markets, it runs 9 to 10%. Right now, volatility is elevated. That's the signal. That's why the yield is where it is. Should I sell before rates go up? Noise. In 2022, JEPI fell 5% during the most aggressive rate hike cycle in 40 years, while the S&P fell 18%. That's the signal. That's your actual data point. The investors I've watched handle this kind of market well over time aren't the ones who react faster. They're the ones who react to fewer things. They've built a portfolio around what they actually need, in this case, monthly income with lower volatility, and they stay out of their own way when the headlines try to move them. JEPI isn't perfect. No fund is. But for an investor who needs income, who can handle the fact that their NAV won't keep up with the S&P in a raging bull market, and who wants a structure that was specifically designed for uncertainty, this environment is not the threat. This environment is the point. Everyone being scared right now is the volatility premium. JEPI is collecting it for you every month. I want to end with one question, and I genuinely want to hear your answer in the comments. When the rate hike news hit this week, what was your first instinct about your JEPI position? Did you want to sell? Did you check the distributions and decide to hold? Did something you heard change how you're thinking about it? Because that shift from I should sell because rates are going up to wait, this volatility might actually be increasing my income isn't just a portfolio decision. It's a different way of reading the market. And once you see it that way, a lot of these scary headlines start looking like very different information. Tell me where you landed. I'm reading everything down there.